If you're looking for new stock market investments, we've got 5 high-growth ETFs that you might want to keep on your radar.
Unlike the most commonly recommended funds around like the VOO or SPY, these funds are intended for a little higher returns.
Of course, you guys, and then we can make $10 million.
With that said, these investments aren't for everyone, but in this video, we are going to give you a couple of reasons why you might want to choose high growth funds and which 5 we'd recommend.
Not financial advice, of course. The first reason for investing in high growth ETFs, of course, is the potential for reward. Thomas Jefferson once famously stated, "With great risk comes great reward." And that's still true today. The more risk you're willing to take, the better chance for higher rewards.
Additionally, if you're willing to let these investments mature for a longer period of time, the better chance you have for even bigger returns. Similar to investing in Amazon or Tesla stocks, which have exploded over the last few years.
The idea is to invest in ETFs that hold innovative companies like these that may be the next company to skyrocket. Remember, there was a time when Amazon and Tesla were highly speculative companies, but the people who took the risk are the ones reaping the rewards now.
They're so rich, they know the future.
A growth fund will have many of these type of speculative companies within it, where most of their earnings are reinvested back into their companies to promote expansion or further innovation.
The result of this is a higher potential for capital appreciation, which in turn means there's little to no dividend distribution.
This is why we'd only recommend these ETFs for investors who aren't looking for dividend payouts and can handle the risk or are okay with dedicating a small portion of these funds into their portfolios.
Before we jump into our top 5 high growth ETFs, another quick tip is to invest in our like button. We don't charge any fees.
0 fees.
So what do you gotta lose?
Well, all of our holdings are tied up in the railroads.
Let's get into our top 5 high growth ETFs with our first on the list, which is the Schwab US Large Cap Growth ETF Fund, ticker SCHG, which tracks the Dow Jones Large Cap Index.
This ETF gives you exposure to over 750 of the largest companies in the US by market cap. Similar to some other top large cap funds, its top holdings include Apple, Microsoft, Amazon, and Visa.
You'll find most of these companies in various funds as they're industry leaders that provide high growth. With an expense ratio of only 0.04%, the fees on this ETF aren't going to eat away at your earnings.
Returns for SCHG have been over 17% since inception and over 18% in the last 10 years. It is also enjoying a whopping 38.5% return year over year, but as with most index funds, a strong recovery this year from the downturn of early 2020 is the cause.
Is 38% sustainable? Probably not. But as with all the ETFs on our list, the returns over the last 10 years are outstanding. Like our next on the list, which is the Vanguard Information Technology ETF, ticker VGT.
This tracks a benchmark of stocks in the information tech sector. Because this sector is so volatile, there's more risk associated with this fund, but over the last few years, it's showing some solid returns.
The fees are a little higher on this ETF at 0.1%, but they are holding a 13% return since inception, a 10-year average return of 21.6%, and a year-over-year return of 44%.
With technology moving faster than it ever has, this sector doesn't look to be slowing down anytime soon. In the top holdings, you'll find the usual suspects like Apple, Microsoft, Nvidia, and PayPal.
VGT holds over $56 billion in assets and has large exposure to the software, semiconductor, and hardware sectors. Look at adding this to your portfolio if you like higher growth, set it and forget it type of ETFs.
Let's keep the ball rolling with another high growth ETF. By now, most of you have probably heard of Cathie Wood and her investment firm ARK, which is an acronym for Active Research Knowledge.
She is consistently in the spotlight as she focuses on the innovative movement on Wall Street. Her disruptive investment model targets companies that are striving to change the world through technological advancements.
ARK's Innovation ETF, ticker symbol ARKK, is a prime example of this. While most top-performing funds hold Apple and Microsoft, Cathie takes another approach with companies like Teledoc, Coinbase, and Shopify, to name a few.
A lot of these companies are up-and-comers and are making their bid to be the next innovative breakthrough. This ETF has a higher expense ratio than most at 0.75% and usually only holds between 35 to 55 companies, which are less than others.
Critics Critics argue that she's playing with fire with the lack of diversity in the fund's holdings, but she believes that the next big innovator is in sectors like robotics or fintech.
You can't argue with her fund's performance. Since inception, it's had a 34% return, and even though it's seen a much slower year at only 5%, it's still holding an 86% return year over year.
Though the fees of this ETF are a little more expensive, this fund has made money since it was created in 2014 and should be one to keep an eye out for.
Next up on our list is BlackRock's iShares Russell 1000 Growth ETF, ticker IWF. This ETF tracks the top 1,000 large and mid-cap companies on the Russell 1000 index based on growth characteristics.
This fund has been a solid investment for many years, as it has one of the highest 3 and 5 year averages at 24.9% and 23.4% respectively.
Currently, it has 496 holdings, 44% of which are in the information technology sector. Some of the top holdings in this ETF are similar to other funds on our list, with companies like Apple, Amazon, Tesla, and Facebook.
The expense ratio is 0.19%, and it holds over $76 billion in net assets. It has a return of 7.2% since inception and a 10-year return of over 17%. IWF could be a great addition to your portfolio if you're looking for a medium to long-term growth investment.
The last and possibly one of the best high-growth ETFs on our list is the Invesco QQQ Exchange Traded Fund, ticker QQQ, which tracks the NASDAQ 100 index.
Investors of this ETF have seen impressive returns through bull markets and a solid overall growth. The downside is that it may decline a little more in bear markets due to its higher risk and no exposure to small cap companies.
Even with this downside, QQQ ranks in the top 1% of large cap growth funds and has a history of outperforming the S&P 500 index. It also has low fees with an expense ratio of only 0.2%.
Like many other high growth ETFs, this fund invests highly in tech, but also includes holdings for multiple sectors and industries. Alongside the top tech companies, you'll find holdings like Pepsi, Starbucks, and Costco.
In the end, this is one ETF that could add a little growth and stability to your portfolio, and is certainly worth taking a look at. That's it for our top 5 ETFs. Let us know what you think.
Are you going to add any of these ETFs to your portfolio? And if so, let us know down in the comments. While you're down there, don't forget to like and subscribe.
And hit the bell notification to stay up to date with our weekly videos on stocks, crypto, finance, and investing.
Good luck out in the markets, and we'll see you next week.